The Powell put turns into the Powell pivot, and COVID trumps it all. This is Bloomberg Wall Street Week. I'm David West. This week, special contributor Larry Summers on Chair Powell's change of heart.
I suspect in the end it won't have been enough.
And Blackrock's Salim Ramji on a generational shift in investors and why things will never be the same again.
That's been a new source of growth for us, particularly with millennial investors coming into the market in a way that they hadn't in years past.
It was a week when global investors had their eye on test results as much as on stock prices or eco numbers, with an Omicron variant setting new records in the United Kingdom.
The wave of Omicron continues to roll in across the whole of our United Kingdom.
And Dr. Fauci saying the boosters we have already should protect us against this new variant.
Our booster vaccine regimens work against Omicron.
All of which left people anxious about where they work and where they travel. Here's Delta CEO Ed Bastian.
We are seeing some cancellations internationally in markets, not for the holidays. This kind of in January and forward, in markets where travel restrictions have been reintroduced.
And anxious about where they live, as Stephen Ross's Related invests in the booming market in Florida.
We're all waiting to see what happens in New York and New York State. You know, there's reason for optimism, but I think, you know, when you look at the tax situation and everything, and with COVID, I think it really has opened up Florida.
But as much as we kept our eye on the virus, it was also a week when Federal Reserve Chair Jay Powell delivered on his promise to move faster in responding to greater inflation than he'd anticipated, with the Fed speeding up its tapering of bond buying just the way we had expected.
We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support.
Leaving investors to plan for possible rate hikes sooner in the new year.
I think the March meeting is potentially live for a rate hike, depending on what happens in the labor market.
And whether it was the virus or Fed tightening or the triple witching on Friday, equity markets didn't like it much, with the S&P 500 down almost 2% for the week and the NASDAQ down almost 3%. But as nervous as equities may have been about higher rates, the bond market went the other way, with the yield on the 10-year actually down despite the more hawkish Fed, ending the week just above 1.4%. To help us sort through this all, we welcome now Sarah Ketterer. She's CEO of Causeway Capital, and Peter Kraus, Aperture Investors Chairman and CEO. Welcome to both of you. Great to have you back. Peter, I'll start with you. What are the markets trying to tell us? There's a lot of volatility, that's for sure.
There's a lot of volatility. That's what they're trying to tell us. Look, I think that we're in a challenging time period. Markets are uncertain. They haven't had much of a direction other than up and down. I actually think that's a message that there's potentially a reset in the market's level here. Interest rates are, as you point out, are lower today, mostly because of risk off, not because of inflation. Inflation would say interest rates should be rising. And the market is down, but the changes inside the market are actually much more dramatic. And I think actually Sarah would be perfect person to comment on that, but that rotation inside the market's quite significant.
So, Sarah, you're the perfect person. I'd be remiss if I didn't say 2017 Morningstar International Manager of the Year. So you should know the answers to these questions. What's your answer?
Markets anticipate well in advance of events. That's the short answer. The elevator answer, and equity markets are beginning to anticipate tightening, and we haven't seen that in a long time. Can you imagine if the Fed takes a $9 trillion balance sheet and reduces it to $6 trillion? That's quite a bit of liquidity that's sucked out of the system. And what has levitated so many stocks to valuation multiples perhaps beyond where they would have gone otherwise has been this tremendous amount of money creation. So we're just looking at the other side of the coin, and the market doesn't like it.
Well, let's go with that exactly, Sarah. How much of this is simply the fact that the market now is saying, wait a second, we may not have the almost infinite cushion of liquidity the Fed has provided. Now saying maybe we won't be there for you.
Well, very hard to parse out how much of the market's machinations are due to concerns about of tightening, but there are all sorts of other events occurring. We've talked about OMICRON, and to the degree there's any slowing as a result of that. It certainly impacts part of the market quite severely. Anything that's pandemic sensitive. So there we've got other moving parts, and then we have still supply chain interruptions, and we have not just cost price inflation of goods and services, but labor, which is becoming a serious issue for some companies. So there are all kinds of events that are weighing on profitability and could compress profit margins, and the market is beginning to anticipate some of this, and that is partly due to why there's so much volatility and the market's pullback.
So, Peter, I think probably the main goal of Chair Powell this week was to say, we've got your back on inflation, we'll take care of inflation. Did he succeed? Did the markets believe him that they really can handle inflation?
I think the markets are a little bit unsettled because the markets believed him when he said inflation was transitory. Now, that was a little bit wishful thinking because the markets wanted it to be transitory. And in fact, some people did not believe it was transitory. Powell backed off of that this week. He moved the dot chart up 3 changes in interest rates next year. Clearly said, inflation is not transitory. And that, definitely had an impact on the market. I think the significant issue for me that I'm watching inside the markets are a change in investor perception or investors' willingness to put capital against high growth stocks. High growth stocks had been, for the last 10 years, benefiting pretty substantially by a very accommodative Fed, which essentially messaged that inflation was very low. In fact, interest rates were actually negative. We had negative real rates. And that allowed investors to pay pretty high multiples for stocks that had very fast growing sales and in some cases no earnings. That's what's changed. If you look at that inside the market, high growth stocks where there are very few earnings or no earnings are under significant pressure. And what's being bought instead of that are quality stocks, stocks that are much lower in valuation, stocks that are a little safer, stocks that have paid a dividend. And that's, I think, really what's happening. The market hasn't really gone down that much. It was at 4,700, it's at 4,600, got the 4,500, sort of bouncing around. But what's interesting to me is the turbulence inside the marketplace.
So, Sarah, what about this? I mean, you can have high growth stocks that actually do have cash flow and do have earnings, and then others, as Peter says, that don't really have it. Is the market distinguishing between those two at this point? As you know, the NASDAQ really took a hit this week.
The longer the duration of the stock, thinking it as cash flow, and if you have to wait years and years, maybe decades for free cash flow, those will clearly be the most rate sensitive. And I would agree with Peter, those are the stocks that seem to have taken the biggest hit of late. But it's also interesting to see what's going on in what had been the biggest leaders in global markets, namely areas such as financials and energy. Particularly energy is looking a little wobbly. And we're almost at the end of the year, and this is a very it's sort of unclear how we'll all end up. And I can't remember a year quite like this. Usually by now it's all done and dusted, and it gets to this idea of uncertainty as to which companies will be the beneficiaries of what is a very uncertain monetary policy. It's really only the Fed the Bank of England is quite aggressive. They've actually raised rates, and the Fed is sort of next in line, and then the European Central Bank is cautious, and the Bank of Japan is not really doing anything. So there's something abrupt happening now, and we're all trying to read the tea leaves, and that's probably one of the reasons why the market is vacillating.
Well, let's talk about one of the tea leaves that, at least around Bloomberg, we talk about a lot, and that's the yield curve. What's going on with the yield curve? It flattened this week.
It did.
Is it a signal to investors about what's coming around the corner?
Generally, the yield curve shape means a lot, and people actually look very carefully at it. However, as Sarah mentioned, and I think this has really been the devil in the details over the last few years, you have a very, very big Fed balance sheet, historically beyond precedent. So how much of that yield curve is actually being impacted by Fed activity? Now, in fact, the Fed has said we're going to slow the tapering, but they really haven't slowed yet. So if every day you wake up and the 10-year or some part of that curve is subjected to cash coming into the market to buy those bonds, that's just going to have a technical impact on the yield curve. So even though we see inflation high, and even though we agree that inflation at 6% is not sustainable and it's going to drop, you still have very significant negative rates because the Fed is still buying bonds. What happens when the Fed literally stops buying bonds? That's an interesting question. The market doesn't really know the answer to that. And that is probably going to create more volatility in the bond market.
So Sarah, come back to you on the equity side here. Given what we saw this week, does it tell you to go into the stay-at-home stocks, to get back into the travel stocks? Where do you go?
Well, at Causeway, we always go wherever everyone else isn't. Sometimes that can be quite painful if we're early, but we want to give our clients access to the most undervalued, best managed, best competitively positioned companies. And this has been, and as Peter noted, the market hasn't, and this is true of most markets, they haven't really fallen much. Maybe emerging has been the weakest. So I'd say that it's not like there's this plethora of bargains out there. We haven't seen a major pullback. But within markets, the stocks that are most negatively affected by renewed lockdowns, quarantines, testing, and that would be travel, leisure, and then related like travel software, those stocks have been hit really hard. And we just have to look back to from November of 2020 when the Pfizer vaccine was first announced, and then the months that ensued through this last spring to see how much upside those stocks can deliver when investors aren't worried about restrictions. So there's a lot of, there's so much pent up potential in parts of the market that unless you think we're going to be in lockdown indefinitely, which I do not, could be really attractive despite the fact the market itself is sort of fully priced.
You know, Sarah made an interesting comment about the end of the year. There are not many examples of that. And you shouldn't necessarily invest for the next 2 weeks. For sure, you shouldn't do that. But 2018 and today have some interesting similarities. Movement in interest rates were actually quite similar. Market uncertainty is quite similar. Now, in 18, the market dropped a lot more. And of course, we're not at the end of the year yet, so we don't know. But there actually is some similarities between the two. I think this year, the market is stronger, the economy is stronger, the consumer is stronger. And so I think that's a differentiating aspect. And so I don't really expect to see what we saw in 18, which is almost a 20% drop in the equity market and a real reset. But we could see some more weakness before we get to the end.
Peter Kraus and Sarah Ketterer will be staying with us as we turn our attention to inflation and what investors should do about it. That's next on Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Weston. Fed Chair Jay Powell did his best to persuade us this week that the Fed will get inflation back under control, and he may be right. But what if he is wrong? Last week on Wall Street Week, our contributor Larry Summers said that if the Fed didn't move substantially, we'd be facing persistent inflation of 4% or more, something we haven't seen in a long time. Peter Kraus of Aperture Investors and Sarah Ketterer of Causeway Capital have stayed with us. So, Sarah, I'll start with you. Let's assume for the moment, it might be wrong, but let's assume that it's right, that in fact we're going to have 4% plus inflation as far as the eye can see. What does that do to you as an investor? How does it change your portfolio?
We've already seen it, and we have analysts scouring the globe looking for attractive investments and companies, regardless of region. And in particular in the U.S., are talking about a level of price and cost increase I haven't seen in a long time, and it's raw materials, it's transport and logistics, and then across the board they're talking about labor. So looking for businesses that can pass on those price increases is part of our job as research analysts. We simply can't put our clients in a situation where companies have to absorb that cost increase. And so that means looking for market leaders, companies that have few competitors. And there are quite a few out there, especially if they're in the, as I mentioned earlier, they're in that blighted aviation, aerospace, travel, leisure segments. There are companies with only, you think about, there's Airbus and Boeing and then Rolls-Royce and Pratt and Whitney. Like these companies have, or Disney, for example, so few competitors that can do what they do, and yet their share prices have been hit very hard. So that's really the answer, is finding especially undervalued, perhaps due to COVID, companies that are in a position to pass on those price increases.
So, Peter, what do you say? Sarah, as I understand it, is saying, look for the moat around the business, as Warren Buffett calls it, right? They're really protected to some extent, strong brands. At the same time, if you're looking for the ability to pass on prices, some of it's the ability of the buyer to spend the money, to pay the money. Right now, we've had that with consumers in this country.
Yeah, I think Sarah's referring to the elasticity of demand that consumers have for a particular product. And what we've seen to date is that consumers, while they're spending a lot, actually have a fair bit of elasticity of demand, meaning that if you increase your prices, the consumer is not necessarily going to be there. And so Sarah's point is that if you can find a company that actually can pass through prices, given that you have an underlying inflationary environment, that's a company that can maintain margins. And if you can maintain margins in an inflationary environment, that's a company to buy. And that makes a lot of sense. Challenge is that we don't exactly know how elastic demand is, and we don't exactly know how effective companies are going to be in doing that. If you come back to the question you asked earlier, which is, well, what if we're wrong? What if Larry Summers is right about inflation being much higher? I think the market would be significantly upset by that. I think the market's basic game plan is either inflation is transitory or it's not transitory, but it's coming down to 2 to 2.5%. If inflation stays at 4%, then it doesn't really matter what the Fed's going to do, because the Fed's going to be forced into acting well beyond 3 hikes to actually bring inflation down to 2 to 2.5%. And that is not an environment that the market is ready for. And that will cause significant market volatility and significant resetting in values.
So Sarah, give me an insight into the way you construct your portfolio, how you invest. Do you provide within your portfolio for that possibility, or do you say, no, I really don't think that's going to happen?
Oh, definitely. We do look, David, at, we call these extreme scenarios, and that way we understand the culprits, the stocks in client portfolios that will likely behave the worst. And in other words, they will have the highest market sensitivity, therefore they will fall more than the market if the market does pull back. And now then it's a question of, well, is there some other feature attribute of the business that makes it worthwhile holding even with that risk? So yes, that sort of risk analysis, we do that continuously within a real focus on these companies that could be, they could end up creating some downside momentum. But every one of these situations is quite unique. And that's, again, one of the reasons why we want to buy them undervalued now. If it's the virus that's created market concern about the stocks and they've been sold off heavily, that means they are lower risk than the overall market. If people don't believe me when I say this, they go, oh, the stock's fallen, must be high risk. No, when it's fallen, assuming it's still the same business it was, it's lower risk. So that's how we look at it.
Peter, we've been talking about publicly traded companies, equities. At what point does it make sense to move into alternative investments, other ways? Give up some liquidity, perhaps, having some exposure in the longer term, but maybe getting some more yield.
Look, well, you can talk about yield, you can talk about equity returns. So if you talk about yield for a minute, the illiquid credit markets have grown dramatically in the last 10 years. And there are many, many investors that have allocated capital to illiquid vehicles that are lending senior subordinated or senior loans to companies all over the world and getting extra spread for that. And that's been a very attractive space. And what those investors will say to their clients is, even in a bad credit environment, you'd rather be the senior secured lender than in the security market, where your position might actually not be as attractive. And so you're getting paid for the extra spread. And that's been a winning argument. And that continues. And you hear the same thing in private equity. But there's no market that can survive too much capital. There's no market that can do that. And both of those spaces, private equity and private credit, are in some kind of challenge in terms of the amount of capital that's been allocated to them, because interest rates have been so low and the liquid markets have been so unattractive.
So, Sarah, this is an interesting point, I think, because there has been so much capital in the marketplace, whether it's private equity or otherwise, so much liquidity. Where do you see shortages of investment opportunity? That is to say, people are not going in as much, and therefore that creates an opportunity for you.
It's in the unpopular segments of the market, and there's still some cyclical stocks that have been left out of market recovery. But I'd say it's I would agree with Peter. There's too much capital chasing too few opportunities pretty much across the board. So clearly the lesser investor embrace sort of more unpopular companies, they're going to have a harder time raising capital, but probably for good reason. And the key is for us is to find these companies in transition where they might have had a setback or they may be slow to change. And now with new management, that's revitalized them. And now they have access, their own cost of capital is falling, their own risk is falling, and they can access the capital markets more cheaply. So, I mean, it's very hard to say there's some part of the market that has been starved of capital. It's a great opportunity. Usually it's starved for a reason because nobody wants to lend to them.
Yeah, Peter, one quick one at the end here. What about from the investor's point of view? Are your investors patient with you because money's been pretty free?
Great question. It's true for Sarah and for Aperture. Look, we try to structure the fees so that if we're not performing, you're not paying anything. That's one of the beauties of the construct. But investors' ability to stay with the investment is really a function of their own internal clock. Yeah. You hope that they can. You want them to. Most investors, if they're honest, will say to themselves, boy, if I try to time the market, I'll get smoked. They shouldn't do it.
Good
but
advice.
It's reality.
Good advice. Many thanks to Sarah Ketterer of Causeway Capital and Peter Kraus of Aperture Investors. Coming up, we take a look at the week ahead on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now for a look at what's coming up next week in Global Wall Street, starting with Juliet Sally in Sydney.
Thanks, David. China's de facto benchmark funding rate may be inching closer to a first cut since April 2020 after policymakers signaled a focus on stabilizing the economy and the PBOC cut reserve requirements for banks. Though it may or may not come as soon as this week, headwinds like the property crisis and weak domestic demand have seen rising expectations for a drop in the loan prime rate, technically set by banks in conjunction with the PBOC. We also have a policy decision from the Bank of Thailand, along with unemployment figures from Taiwan, inflation data from Singapore and Macau visitor arrivals, which are likely to show the continued impact strict border controls are having on the gambling hub.
On Monday here in the United Kingdom, Rightmove released house price data. On Tuesday, the Eurozone report consumer confidence for December. That's going to be an interesting figure since the discovery of Omicron. Has that impacted consumer psychology so far? On Wednesday, EU taxonomy is the focus. The bloc is expected to announce whether natural gas and nuclear energy fall under the EU's new green investment rules. On Thursday, Russian President Vladimir Putin will give his highly anticipated annual address. The market will be watching for any inflammatory language toward the West and Ukraine.
I'm Romaine Bostic in New York. A holiday-shortened week ahead that will still feature a big batch of economic data, including numbers on personal spending. Growth there is expected to have slowed to less than 1% on an unadjusted basis. The big question is, when you adjust for inflation, will the slowdown prove more severe than at first glance? As for inflation itself, we also get new data on the personal consumption expenditures price gauge, which is the one the Fed uses for its inflation target. In October, that gauge rose 5% from a year earlier, in what was the biggest increase since 1990. The November increase is projected by economists to be even bigger, about 5.7%, which would be the sharpest year-over-year gain since 1982. Finally, keep an eye on corporate earnings. We'll get reports next week from chip maker Micron, cruise ship operator Carnival, cereal company General Mills, and athletic apparel icon Nike. David?
Thanks to Juliet, Laura, and Romaine. Coming up, the younger generation leads a revolution in the markets, and it goes way past meme stocks. We talk with Salim Ramji. He is BlackRock's head of iShares and index investing.
The big new news has been retail investors, so self-directed investors really coming into the marketplace.
This is Wall Street Week on Bloomberg. Meme stocks, one of the things we discovered or invented in 2021, as the Reddit crowd used Robinhood to make GameStop a hit. to be met with surprise and a fair amount of skepticism from people like Rod Alsman of GMed.
I don't think you can recreate a company that had been in the analog era for its existence into a pure digital player or digital first player overnight.
And if meme stocks weren't enough, we had the explosion in cryptocurrencies, including ETFs of crypto companies, which the CEO of Binance says could catapult crypto into the mainstream.
They can typically reach customers that we were not able to reach.
But the focus on meme stocks and crypto is only a part of a much larger story. The story of the growth of retail investors in the market overall, according to Catherine Keating of BNY Mellon.
The structure of the markets has changed during our lifetimes. Today, the retail segment of the market, the assets that are governed by individuals, is larger than the institutional segment, and it's growing faster.
And the driving force behind this historic surge? It's the demos, what Bernard George of online broker Tornado calls a generational wealth transfer.
We're at just the beginning stages of a massive secular shift in the space. There's a $60 trillion plus generational wealth transfer taking place right now.
And when it comes to ETFs and retail investing, there really is only one leader in the field. He is Salim Ramji. He's head of iShares and index investing for Blackrock. They oversee $6 trillion in assets, $3 trillion of which is in ETFs. Welcome to Wall Street Week. Great to have you here, Salim.
Thanks for having me here, David. It's a great privilege.
2021, record year for ETFs.
Yeah.
Explain us how that record got set and why.
Yeah, it's actually an amazing story. So ETFs are now 32 years old since the first ETF was launched. And if you go back to around the time that BlackRock bought BGI, there was just about $1 trillion in ETF assets in total. Now there's that much has happened in the course of a given year. And so when you go back to the reasons why, I think it's got a lot to do with convenience. It's just an easier way for many people to invest. And it's got a lot to do with choice. I mean, we now have something like 1,200 different ETFs around the world. And so it provides investors lots of different ways to access the investments they want, not just here in the US, but across Europe, across the world, because of the exchange-traded way in which it works.
So some of us think of it sort of like retail investors and institutional investors.
Yeah.
Do they invest differently? Do you see a different pattern when it's the retail investors investing in ETFs as opposed to the institutions?
Yeah, and there historically have been two big clients. And so across our ETF business, we have about 30 million investors within iShares, and then there's about another 90 million in our index capabilities outside of it. And our origins were as institutions, different institutions wanting access to international markets, wanting access to the bond market. The big driver of our growth has also been wealth advisors. Looking to build portfolios and having ETFs in components. And I think the big new news has been retail investors, so self-directed investors really coming into the marketplace in significant size, especially over the past year and a half during the pandemic. And I think that's been a new source of growth for us, particularly with millennial investors coming into the market in a way that they hadn't in years past.
That was going to be my question, actually. How much of this is demographic? How much of it is actually generational?
Well, some of it, like the existing investors that we have today, and one big part of the story as to what has driven the inflows, has been just more and more existing investors putting more of their money to work because they liked what they saw in some of the early exposures, and they just keep adding as they save more. But I think the new force, and why we're pretty optimistic that the 120 million investors that we have will be 200 million over the course of the next 5 years, is this millennial investor coming in. And just to give you one kind of number, even if we just look over the past, since 2020, 30 million more Americans have opened up investment accounts just in the past year or two. And that's more than have opened up investment accounts in the prior decade. And the average of those investors is a millennial. 32 years old, they're coming into the market for the first time. They're looking for something convenient. They're looking for a good deal. And many of them are turning more and more to ETFs.
And how much do they typically start out investing?
So it completely ranges. So our, if I give you an example from outside the United States, just to give you a sense of it, we have German investors investing in ETF savings plans, and they're putting about 150 euros a month. And so we're seeing investors start out with small amounts, in many cases even smaller than that. A third of the investors in the United States have less than $500 to start, but they're saving a little bit every single month. And while that won't drive gigantic flows this year or next year, if you take a 5-year horizon or a 10-year horizon, they could be as significant, as important as institutions are, as wealth advisors are, as any other demographic segment is for us.
How active in general are these self-directed investors? Because some people have speculated that the retail investor is more likely to get in and out of various stocks and various indexes, ETFs and indexes over time. Is that true? Do you see them to be more volatile?
Yeah, I've seen, if you think about the 30 million new people who've opened up accounts just in the United States, I mean, there are a lot of differences amongst 30 million people, but at least as we look at the numbers, and there's been a lot of discussion, a lot of excitement, particularly earlier this year, about meme stocks and just the impact of retail investors on that. But when you look at the broader lens, 2/3 of all retail trading volume in the United States is going into ETFs. And that's a somewhat more, it's a less exciting story. Certainly it's exciting for me. It may be less exciting kind of on a day-to-day basis. But what's really driving it is methodical day-to-day investment behavior. Most of this is purchases. So it's mostly people putting small amounts of money into the marketplace. It could be in equities, it could be in bonds, it could be in some combination of those. But they're looking to it for its simplicity or for its ease or for its low cost or for things that have driven index investing for 50 years since the first index capability was introduced.
So I'm just assuming you've taken the friction costs down. And by that I mean things like going into some paneled office and meeting some stockbroker and filling out a lot of forms. And for that matter, paying a fair amount of fees.
Yeah, well, the great thing is fee-based advisors are a really important constituent for iShares. And what we found over the years, and this is true in the United States, it's true outside of the United States, that advisors embrace more of a fiduciary mindset. They use more ETFs. And that's great because ETFs, we think, are a very important building block of a well-constructed portfolio. And so they're a really important segment. But when you think about a first-time investor, and particularly a first-time millennial investor, they're often getting into the market through self-directed platforms or through online platforms. And that's just a different way of engaging. And one of the things that's been a real boost, if you will, to ETFs is if you go back 3 years ago, most online platforms charged a commission to trade iShares. Now today, virtually all of them enable people to do that commission-free. That's in the United States and that's in Europe. And what that's done is that it's taken down the barriers to ETF adoption. And once those barriers come down and the friction is reduced, as you said, then you find more and more people using ETFs. And that's true if you're a wealth advisor and if you're focused purely on the client's fiduciary interest, you tend to use more ETFs. And if you're a self-directed platform and you take out the commissions, you tend to use more ETFs. And we think that's great for investors.
And you at BlackRock, as I understand, slice and dice this a lot of different ways. There are a lot of specialized ETFs.
Yeah.
Talk about specifically in the ESG area, environment, for example.
Yeah, and this has been a real change for us, particularly over the past 3 or 4 years. And it was catalyzed and sparked first by our CEO, who really started to understand and be quite vocal around climate risks as investment risks. And so with that lens, we started to understand the long-term consequences of thinking about risks from a fiduciary lens and thinking about the long-term risk and return dynamics. And then what we did within iShares is kind of based on that investment thesis, is we started to rapidly expand choice. So if you go back again 3 years ago, we had a couple of dozen ETFs that were ESG oriented. Today we've got 180. And what it allows clients to do is just more choice. And so a certain client may choose to screen out certain exposures or certain industries. Other clients may want to invest behind a lower carbon transition. And one of the things that I was particularly proud of this year is that when we launched our low carbon transition ETF, and it was an active ETF, it was the most successful ETF launch in US history, active or index. And so it just shows you the breadth of what the ETF wrapper can do. It can wrap ESG and market cap, it can wrap active and index. And if you're able to do something in a convenient way, in a low-cost way, in a transparent way, it turns out more investors want to turn to it. And we think that's good for the long term.
Salim, you described rapid growth, rapid expansion. They always taught me trees don't grow to the sky. Where's the sky for you?
Still a long ways away, because I think the remarkable part about the journey that we're on is that when you look at the ETFs as a percentage of our addressable market, we're at 3%. Slightly higher in the equity markets, slightly lower in the bond markets. But what it says to us is that there's a vast, vast opportunity to make bond investing more efficient by doing it through an ETF, to help clients find all sorts of new sources of return in the equity markets. And so there is still a long way to go. If in the scheme of kind of the financial markets in which we operate, we're a sapling, and we're still pretty small, even though we've experienced pretty rapid growth over the past 10, 20 years.
It's a fascinating story, and thank you so much for sharing it with us. Salim Ramji, he is head of iShares and index investing for Blackrock. Coming up, we wrap up our week, as usual, with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're going to conclude our week, as we always do, with our special contributor, Larry Summers of Harvard. So, Larry, this week, Fed Chair Jay Powell did what he said he'd do. He said we're going to taper a lot faster. We're going to get to the possibility of rates sooner. Did he do enough?
I suspect in the end it won't have been enough. You know, what they're planning is 3.5% unemployment for 3 years, with steadily decelerating inflation, without the interest rate ever getting as high as what they think the neutral rate is. That could lead to sharply declining inflation, but it wouldn't be my expectation that that's what's going to happen. On the other hand, there's a case for making adjustments gradually, and it may be that this is the first stage in what will be several adjustments, and it needs to be recognized that the market doesn't even expect them to hike as much as they're saying that they're going to hike. So it's a complicated situation. I was glad to see the movement in the direction that they moved. But I think if you look under the surface, they're still kind of betting that inflation is heavily transitory, because they're not really applying restraint to the economy of a magnitude that would be expected to diminish inflation in a very substantial way.
Well, let's talk about the transitory, because we've talked to a couple of economists this week. Austin Goolsbee used to be White House economist. Cecilia Rice, whom you know well, current White House economist, who don't use the word transitory, but they say something close to that, saying, look, whether this affects inflation or not depends on the causes of it. And if the cause is really some supply chain problems, those are going to go away on their own. And therefore, we didn't need to do as much on monetary policy. What do you say to that?
Cece's a former student of mine and someone I respect greatly, but I don't see it quite the way she sees it. Here's what I see. I see shelter is 1/3 of the CPI. I see house prices going up 20%. I see every private sector rental index up in double digits. And I see the CPI calculated with long lags and only up 3 or 4%. So that says to me that we've got another 8 to 10% of shelter inflation coming in, weighted by 1/3. That's almost 3% right there in terms of a contribution to inflation. I see a red-hot labor market with labor shortages, with hourly wage rates accelerating, and ultimately, labor's the most important source of costs, and all the businesses I talk to and all the businesses where I read reports from stock analysts say they've got a lot of pricing power. So if you take housing and you take labor, and then you add to it, David, that the consensus forecast is for the economy, the Fed said, to grow something like 4% during 2022, and you take an economy that's growing 4% with almost no productivity growth and a labor shortage, I think you're going to see new bottlenecks emerge, even as old bottlenecks are fading away. So it might turn out to be the case that they're right, but I don't think we can plan on it. And I am concerned that we've hidden the word transitory, but we haven't hidden the concept that inflation is going to solve itself. And I think that idea was wrong, and that's why I was encouraged when Secretary Yellen and Chairman Powell said they weren't going to use the word transitory anymore. But I think that idea is still very present, and my fear is that it's a problematic one, and my fear is that it's an idea that's going to do damage to policymakers' credibility. But no one knows, and this might work itself out in a reasonable way. Certainly, OMICRON is a big wild card that could change everything. Whether it's going to do more to reduce demand than it does to reduce supply, in which case it would slow inflation, or whether it's going to do more to reduce supply than it does demand, in which case it would tend to increase inflation. I think that's very hard to judge at this point.
Well, since you raised Omicron, let's go to the virus question, which is another huge story this week, obviously. Where are we from your point of view? And by the way, do we know enough about this disease? Why, this far in, don't we know more about Omicron and what it does?
Look, the effort both in the United States and globally to have in place adequate testing capacity and adequate sequencing capacity, so at least at all moments we know what we're dealing with. We're still not there, and that's a real problem. And Omicron's not going to be the last Greek letter associated with COVID, and COVID's not going to be the last pandemic threat we face. And so it's a matter of super urgency that the world get itself organized for more satisfactory genetic surveillance so that we can answer some of these questions. Look, I think two things are clear. One is that this thing grows much faster exponentially than its predecessors. There are doubling times in many places of 2 or 3 days. The other is that it's likely, very likely, that it is less virulent. But, you know, if it doubles every 3 days and it's only a third as virulent, that means you're going to have more serious cases after a delay of 6 days than you would have with the other version. And so I'm worried that the combination of more rapid exponential growth and an arithmetic factor for better health improvement is going to leave us, at least for some interval, in a problematic place. And I'm struck, as I'm sure all your listeners are struck, David, by the fact that just in our ordinary lives, there's been an explosion in the last week of anecdotes we're hearing about people we know who have gotten COVID. And so I think this is going to be a pretty traumatic period we're going to go through over the next month or 6 weeks. And the experience has been that these things tend to end slower than people expect rather than to end faster than people expect. So I think from a broad social point of view, anxiety is unfortunately the right place to be.
Laurie, a big development that did not happen this week was the Build Back Better plan getting through Congress. We're going to go into next year on that. I wonder, though, is it possible that Joe Manchin, the senator from West Virginia, might have a point? Because you said in the past you think there's a lot that's good in that bill, but is it over-inclusive? For example, I'll pick one out, child tax credits, which came up at the end of the week as a big issue. If you look at it, getting children out of poverty, I think everyone has to agree with that, but the expansion of the child tax credit goes well past poverty.
I think it is possible, and I remain hopeful that Senator Manchin is going to have had an immensely positive impact on a bill that passes. For us to do nothing to extend in any form any kind of child credit, for us to substantially underinvest on green investments, for us to do nothing on either pre-K or child care, I think all of that would be very, very unfortunate and would set our economy back. But are there plenty of ways that this bill can be improved? Yes, there are. The budgeting can be made more straightforward. over the 10 years, so that we've got 10 years of expenditure in 10 years. There can be a greater focus on the cost effectiveness of the money that we spend rather than just on the allocation of money to key priorities. And there's certainly opportunities for revenue raising that should be taken advantage of, like carried interest, that somehow remain unaddressed in this bill.
And Larry, finally, let's wrap up the week just briefly here with outrage of the week. I understand you have one.
Yeah, I do. People in Congress who get information on legislation that affects the value of companies shouldn't be able to trade in those companies, period. I'm all for capitalism. I'm as much for capitalism as Speaker Pelosi is, but when she defended the current set of special interest, conflict of interest rules as capitalism, she was making one of her very rare mistakes.
Should we make them put it all in blind trust?
We should probably make them put it all in mutual funds and not trade in specific securities that could conceivably be objects of public policy. Blind trusts are a kind of unwieldy thing, but there's no reason why they can't do what most people think is the smart investment practice anyway, which is to put your money in various kinds of passive index funds.
Okay, Larry, it's always such a treat to be with you. Thank you so much. That's our very special contributor here on Wall Street Week. He's Larry Summers of Harvard. Coming up, to tax or not to tax? That is the question for Congress. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Please pass the SALT. With the president's Build Back Better plan pushed to 2022, there are a host of issues still unresolved. Issues like the limits on taking deductions for state and local taxes, that SALT problem we hear so much about. With Democrats from high-tax northeastern states, like Congressman Gottheimer of New Jersey, insisting that bringing back the deduction in full wouldn't help only the wealthy.
A nurse and a journeyman electrician will make enough money that when we reinstate SALT, they will get a $3,500 tax cut. So, like in everything in life, it depends where you live and the impact it has on your family. Where I live, SALT is critical to giving people a real tax relief so they have more money in their pockets to afford everything.
But others, like Bill Ackman, say it would be a wealth transfer that, quote, makes no sense. And our special contributor, Larry Summers, calls it a potential tragedy.
It would have been a real tragedy, David, I think, if the provisions had ended up being written in a way where people in the top 0.1% of the income distribution got a substantial tax cut. I think we're moving towards fixing that.
So at this point, we're at an impasse, with the Democrats badly divided, according to Libby Cantrell, head of public policy at PIMCO, over something that could cost $100 billion a year.
The caucus is split, and we probably think that the solution will be split as well. It will not be a full reinstatement of the deduction.
So if you're waiting for the congressional elves to come down your chimney and put some nice tax break in your stocking this Christmas, you might instead get a lump of coal. That is, if coal is still permitted under the Biden climate plan. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.